The Magnificent Seven stocks get a lot of attention, and for good reason. They've created massive amounts of wealth for people. And even as they're the most valuable seven US based publicly traded companies, they generally continue to deliver outsized returns for their shareholders. I'm Jason Hall. This is Investing Unscripted, and we're going to go off script and we're going to talk about my Magnificent Seven stocks for housing. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, go to our special link. You see it here on the screen. It's fool.com/unscripted. The Motley Fool is going to give you their 10 best stocks to buy right now. Go to that link, check it out for even more great investing ideas. I'm going to bring up the Magnificent Seven and their performance over the past year. They've been incredible investments overall. Now, this is 2023. What a run. All seven of these companies, you had the seven most valuable stocks in the market, all gain value. The worst performer, Amazon, was up 49%. The market was up 26%, the S&P 500. A massive amount of that was because of those Magnificent Seven stocks. I'm going to look at them over the past year because, well, while we've seen NVIDIA continue to run, Meta do quite well, we've seen a little bit of coming back to earth. And now Tesla, over the past 12 months, actually is losing investors' money as the luster's coming off based on its more recent financial performance and challenges in the EV market. I don't want to spend a lot of time talking about the Magnificent Seven stocks. Suffice it to say this: by and large, these are great companies, and as large as they are, they still have runway to continue growing their revenues and earnings. But they're not the only game in town, and they're not the only way to invest. And one of my favorite places to invest, especially right now, is looking at opportunities in housing. We know in the US, housing is tough. If you want to buy a house, single family home, it's really hard if you don't already have a house. And if you have a mortgage that you got anytime in 2020 or 2021, even early 2022, buying the same house today would cost about 50% more. But there are opportunities. The demographic trends are very favorable, and it's actually been a pretty good place to invest recently. Like I said, I'm going off script a little bit here. This isn't the same as the Magnificent Seven stocks. Again, those seven largest, most valuable by market cap US stocks. These are not the most valuable by market cap seven stocks that are involved in housing to some degree. These are my favorite seven stocks to give you exposure to housing and residential real estate in some fashion. So we're taking a look at their performance in 2023, the full year results from the beginning of 2023 through the end of the year, and not exactly the same kind of returns that we saw from the Magnificent Seven, where they all delivered at least 49% gains or better, but still pretty good. We had one that underperformed in Mid-American Apartment Communities, also called MAA, one lost money, and we also had Home Depot, 13% total returns, trailed the great market return that we got. But from there up, it was 50% and better returns. We had two that more than doubled, another one that almost doubled, another one that generated 90% plus in total returns. So what are these businesses? Let's go through them in order. We're going to start right here at the top. We have Meritage Homes and NVR. These are two home builders. They build homes, they sell the homes, develop the land. Meritage focuses on the entry-level market, mostly building homes on spec. In other words, they're not custom homes where they have a buyer come in, put down a deposit, design how they want it custom built, and then they build the home and then they deliver it to that owner. They build these houses on spec, and somewhere along the process of building it, somebody comes along and buys it. They get great margins. There's massive demand. And entry-level housing is where there's the biggest demand and the most weakness in inventory. So this is where Meritage Homes is focused. NVR Homes is one of the greatest investing stories of the past 30 years. It's a company that went through bankruptcy, emerged from bankruptcy, and because of their access to capital was so challenged as a company that had just gone bankrupt, they developed what has become the gold standard way to build houses. And that's an asset-light model where you don't buy a bunch of land and use a bunch of debt to own it, sit on the land for years until you're ready to develop it. They use options to acquire land. They hold the option for that land, and then they acquire the land when they're ready to build on it. This means their balance sheet is more asset light, less debt they have to deal with, less inventory and debt they have to service for that land inventory that's unproductive. They also do some loan mortgage originations, do that part of the business as well. That's been pretty good. Here's how this business is. This is the only home builder I know of, certainly the only publicly traded home builder that came through the global financial crisis, the housing crisis, and didn't lose money. came through it completely unscathed. So many other home builders went out of business, and just about everybody else lost a lot of money. Up next is Home Depot. Everybody knows what Home Depot is. Why is this one such an important fit in the housing bucket? Number one, Home Depot does a tremendous amount of business with professionals. Sure, they have the big retail stores, lots of DIYers that go in there, but they do a ton of business with the companies, with the pros, the ones that you contract out when you renovate your house, rebuild a deck, redo your kitchen, redo your bathroom. They cater to the pros more than the other big box home improvement stores do. The other part of it, too, is the secular tailwind around existing homes. The average home in the U.S. almost 38 years old. A lot of houses that were built in the early 80s, 70s, 80s, even the early 90s, they're starting to get a little long in the tooth and show their age. Time for improvements. As we move to more hybrid work environments, more people working remotely, this is the reality of the way the world has changed. Sure, we're not all going to be working in our houses, but a tremendous amount of people are working from home at least some of the time. They need more from their homes that need to be improved. These are the realities of what we're dealing with. Factor in one other demographic trend, the aging of America's baby boomers. As they're getting older, they need their homes to be improved with more lighting, more safety features as they age in place. These are all things that are great trends that are going to play out really well for Home Depot over the long term. MAA, I mentioned before, go back and look in our library of videos. You'll see one that Tyler Crow and I made, taking a look at two dividend stocks that are beaten down right now that we think are worth buying. MAA makes that list. This is the largest publicly traded owner of apartments in the U.S. They have a tremendous amount of inventory, and they're focused in the best geographical markets in the Sun Belt and a little bit in the West, a little bit in the Mid-Atlantic. The markets they focus on, they're growing faster. Populations are growing faster than the overall population of the U.S. Jobs and economic opportunity are healthy in those markets. That means it's a good place to be as an apartment owner. They've done a really good job of having great inventory with exposure across different price points and different feature sets. They have a good balance sheet. The stock is beaten down a little bit right now. It's created an opportunity for investors to invest. So it makes my Housing Magnificent 7 list of stocks. What else do we have here? You know what? If you're trying to buy a house, you need money. So I want to talk about SOFI Technologies. I think this is an exciting bank investment to make on the future of housing. Why? Why go with SOFI Technologies instead of, say, Bank of America or Truist Financial or one of these other big banks that have tons and tons of mortgages on their books? Well, they have tons and tons of mortgages on their books. A lot of them are loaded down with these mortgages that we all got when they were 2.75% or 3% or even less. Guess what? SoFi has started moving into residential mortgage lending, and they're not weighed down with a bunch of low-yield mortgages in this higher interest rate environment. That means that they're built to profit from the higher interest rate mortgages that people are getting in this environment. I think that is a competitive advantage, positions them with a better balance sheet to be able to more aggressively grow their mortgage book as the housing market recovers and the tailwinds of younger people looking for housing continues to grow. Guess what? Younger people are also more likely to be interested in banking with SoFi, an online-only bank that has really made tremendous headway, growing customers at a 30% rate, growing revenues at a 25% plus rate. They've reached profitability, and it looks like they're going to continue to be GAAP profitable going forward. So SoFi Technologies, that's my bank for the Magnificent 7 for housing. We got a couple more here for you. If you're looking for a house, you're probably going to go on Redfin. Redfin has some built-in advantages, lots of data. People use their platform to find properties. Guess what else they find when they go on that Redfin platform to find properties? They find properties that Redfin is listing. That's really powerful. That's where Redfin makes its money. They're a real estate agent. They're a real estate brokerage. That means that you can sell your house with Redfin. If you buy your house, you can work with a Redfin agent to buy a house. That's a really attractive business to be in. Now, you go back about a year ago, and there was this massive amount of concern that Redfin was going to go completely belly up. The business has come through a rough time, generally unscathed. The stock price has bounced back, but it's still way, way down from where it was 4 or 5 years ago. I think the business is stronger than people give it credit for. They've proven to be nimble. Management with Glenn Kelman have done a wonderful job of managing their balance sheet, downsizing the business based on the weakness in the housing market because there's no inventory. As inventory opens up and as pent-up demand continues to flow into it, I think Redfin is set to be one of the big beneficiaries. We've got one more stock to talk about, and this is TREX. And depending on your view on some of the Magnificent 7 stocks, this might be the one that maybe it's your NVIDIA. If you're somebody that thinks NVIDIA is overvalued, or maybe your Apple, or one of those stocks that you might view as being a little bit overvalued. I might be projecting a little bit with some of those names that I'm putting out there. We'll go with the Apple comparison here because Apple's business has slowed a little bit. Seems like it's gotten mature, yet by and large, the stock price is held up, even though earnings aren't really growing so much and a lot of the business is mature and parts of it are actually maybe even a little bit weaker than they were in the past. You look at TREX, its revenues have definitely come down. That's because of the cycle for what its business is, and that is the wood alternative decking that it makes. It is the market share leader. Well, people aren't buying as many houses as they were. Interest rates have come up. It's made it harder to borrow money to build a $5,000, $10,000 new deck or to replace an existing deck. Because of that reality, business results have suffered. Yet investors have been pretty aggressive about continuing to bid the stock up higher. Now, you can go back over the company's history and you can look at its stock price and you can see times that it looked overvalued. And fast forward 5 years, investors still did really, really well. It is a very high quality, very well run business. It's also a business that, with the demographics of housing, think about that aging housing stock we talked about when we talked about Home Depot. Think about the trend of younger home buyers who are more thoughtful about the environmental impacts of their investments on their property. All of those things are very favorable for TREX, which still has a tremendous amount of room to take market share from regular wood. And as the overall inventory of houses grows, more people are going to want outside areas to entertain as they, again, want to get more out of their house that they're spending more of their time in. So there you have it. There's my magnificent 7 stocks for housing. By and large, a lot of these have absolutely beaten the market over the long term. And just like with the real Magnificent 7, there's a little bit of something for everybody. Whether you're looking to get growth, you're looking to earn dividends, you're looking for the best total returns, you're looking for stability with some upside, just about anything you want as an investor, whatever your goals are, this is an opportunity and a way for you to build a portfolio more well-rounded while focusing on the opportunities for housing and the trends for the long term. It can help you create more wealth.